Over the past 2 years, Warren Buffett's Berkshire Hathaway has been selling off a substantial portion of their stock portfolio. They've been a net seller of stocks for 9 quarters in a row now, which has led to their cash balance hitting a record level of $334 billion as of their most recent quarter. We all know Buffett is the most followed and the most mimicked investor out there, so all of this recent selling has been interpreted as him thinking the market has become too expensive. Back in 2001, in an interview that he did with Fortune magazine, he gave us very good insight into how he thinks about markets overall being overvalued or undervalued. And he mentioned a few key metrics that he looks at, one of which is after tax corporate profits as a percentage of GDP. So if we think about the US economy overall as if it were just one big business, this is basically the same thing as when a business is able to increase their profit margins. So, an increase in this metric would basically mean that US businesses are capturing an increasingly larger share of the gains stemming from economic growth. And interest rates play a big role in this metric, since, as we can see, during the high interest rate period of the 1980s, this metric was at its lowest. And then, when rates became near zero, pretty much after the year 2000, this metric doubled from 5 to over 10%, and it's pretty much stayed there since then. So, if you accompany this metric with perhaps his most famous metric that he looks at, which is the Buffett indicator, which is essentially a price to sales ratio for the entire US economy, it gives you a pretty good sense of how expensive the market is at a given time. Buffett even described it as the single best measure of where valuations stand at a given time. And as we can see, this metric is currently at a historic high. It's at nearly 200% right now, and it's been quite elevated for a long time, especially compared to what it was in the pre 2000s era, where it barely even crossed 100%. Now, you have to think that one of the reasons for this is what I showed before, which is the rise in overall corporate profitability. But Buffett himself has been saying that finding good deals in this market has been difficult for many years now. Even in his 2017 letter to shareholders, he said that prices for decent but not spectacular businesses have hit an all time high, and that prices seem almost irrelevant to an army of optimistic purchasers. But he's also said that he'd much rather be invested in good businesses than just hold cash. But he's also not afraid to hold cash for an extended period of time if he can't find any compelling investments. Their preference is usually to buy a full ownership stake in private businesses and stay invested in them for the long term. Then they look to invest in publicly traded equities of companies that they feel are great businesses at fair prices. And if they still can't find any good deals, then they'll look to their own stock and they'll do buybacks if they feel that it's undervalued. And it's now been 2 quarters since Berkshire has done any buybacks, so they even feel that their own stock isn't cheap enough to invest in, which leaves them with a ton of cash that they can't really do anything with other than invest it into US treasuries. Now, it's worth pointing out that Buffett's actions here are a anomaly amongst the major fund managers around the world who have all reported having record low levels of cash just as early as last month. This metric, which is reported by Bank of America, where they survey fund managers and ask them what their cash holdings are, it recently registered just 3.5%, which is the lowest reading since 2010. And this actually triggered their own sell rule, which says that if this metric goes below 4%, then that is apparently a sell indicator for them. So while fund managers in general are holding very little cash, Warren Buffett is doing the exact opposite. Now, the only time in history that Buffett's cash pile has hit a similar level was in 2006, just a few years before the great financial crisis of 2008. Now, there's been some debate about whether or not Buffett had some kind of inside knowledge about what was going on leading up to the financial crisis because he almost seemed too well prepared to capitalize on the eventual crash. However, it's important to keep in mind that Buffett has never made investing decisions based on economic predictions. He said many times throughout the years that making predictions about the economy is a fool's errand because no one really knows what's going to happen and there's really no reliable way of predicting anything. His famous quote on the topic is, "We've long felt that the only value of stock forecasters is to make fortune tellers look good." So the fact that his cash position has increased before the 2008 recession was more so to do with two things. One, valuations were rather high at the time, and Buffett was having a hard time finding good deals. The Shiller PE ratio around this time was about 25x, which may seem cheap relative to what it is today, but at the time that was actually quite high. And then also because of Berkshire's insurance operations. So companies like Geico and General Re, these were performing extremely well those years. So their insurance float was very, very high. It hit $50.9 billion that year in 2006, which means they had a lot of cash to invest. 2006 was a unique year where there were very few natural disasters, which would have caused them to make payouts to their insurance customers. And Buffett himself even said in his annual letter that year that Mother Nature had gone on vacation. So when 2008 finally hit, they were uniquely positioned as this massive company with a ton of cash that could buy up all these distressed assets, or basically companies that had fallen in value a lot. They could invest in them at very favorable terms. For example, he invested $5 billion into Goldman Sachs preferred shares with a 10% dividend yield, as well as warrants to purchase an additional $5 billion of Goldman common stock at $115 a share, which was already below what Goldman's stock price was at that time. So obviously a very favorable deal for a company that had fallen in value quite a lot then. And Goldman ended up redeeming the preferred shares a few years later in 2011 for $5.5 billion, so a $500 million premium. And he did also end up exercising his option to buy all of that Goldman stock, which he held for about 10 years before completely selling the position in 2020. He also invested $3 billion into preferred shares for General Electric, also at a 10% dividend yield, which included a similar option to buy $3 billion of GE common stock at 22 and a quarter for up to the next 5 years. So another example of a very low risk deal in a large reputable company that's been around for a long time that had very substantial upside for him specifically, all because he was sitting on a massive cash pile and just waiting for the right time to deploy it. And then later in 2009, he made his biggest deal ever at the time, which was for a railroad stock called Burlington Northern Santa Fe Corp, which was for $26 billion, which is a company that they still own today. So if and when the next market crash finally happens, I would expect Berkshire to make deals that are similar to what they did in 2008 because they have this massive war chest that they can deploy at any given time. Now, there is another possible explanation for Warren Buffett's big cash pile that I don't see being discussed very much, which firstly has to do with the succession planning of Berkshire Hathaway, and then also has something to do with the size problem that they've been facing for many years now. Warren Buffett is getting old. He's currently 94 years old, and his business partner, Charlie Munger, passed away in 2023 at age 99. Now, some of you may have heard of the Buffett Giving Pledge, which is something that he started a while ago where he encourages the richest Americans to donate at least half of their wealth to charitable causes upon their death. And Buffett himself has pledged 99% of his net worth, which is just his ownership in Berkshire stock, to be donated into a charitable trust, which will then be distributed to various charitable causes by his children, all within 10 years after his death. And then for Berkshire, it was confirmed in 2021 that Greg Abel will take over as Buffett's role of CEO of Berkshire. He's currently the head of all non insurance operations. And then there's also guys like Todd Combs and Ted Weschler who will assume more responsibility when it comes to making the actual investment decisions. So it's possible that in anticipation of this, he's opted to take a more conservative investing approach for Berkshire and not make any major investments that could jeopardize the value of his Berkshire stock. Or, in other words, he doesn't want the new investment team that takes over for him to be in a tough situation where they invested too heavily into a historically expensive market. Having all of this cash means that Greg Abel and his new investment team, when they take over, will have a ton of flexibility and won't have to worry about having all this money tied up in overvalued companies. I mean, why go and make all these new investments in an expensive market when you have treasuries that are yielding 4.5%, and really you're just risking investing into a company at a poor price? And then also there's the big problem that Berkshire has had for a long time now, which is just that they've become too big for their own good. When you're a trillion-dollar company with over $300 billion to invest, there's really only so many companies out there that you can actually invest in that will move the needle for you. And when you're that big, you can end up influencing the prices of the companies that you want to buy. They even said in their 2012 letter to shareholders that due to their size, making meaningful acquisitions has become challenging. And this was 10 years ago. Now they're roughly 5 times as big as they were back then. So if you think that all the companies that you can realistically invest in that will actually move the needle for you are just too expensive, then you don't really have much to invest in at all. Even some of the recent companies that they've purchased, like Constellation Brands, Pool Corp, and Domino's Pizza, these are all companies that they now own sizable chunks of, but they still each only make up around 0.5% of their total equity portfolio. It's why Apple has been their biggest individual stock position for several years now. It's valued at around 75 billion, and their second largest position is American Express at around 45 billion, which means that they own 21% of American Express stock overall. In fact, the $330 billion in cash that they have right now actually means that they could acquire full ownership in all but 24 of the companies currently on the S&P 500. So Berkshire's size problem has become even more prevalent due to the current market conditions. So it'll be interesting to see what Buffett's next moves are, but personally I think that the size problem that they're facing right now, as well as some potential considerations for the succession planning of the company, are also playing a role in why they have so much cash right now. And it's not all due to the fact that market valuations are just simply too high, though that is definitely a big part of it as well. So that does it for this video, guys. I hope you did enjoy it and you learned something new. Before I go, I wanted to quickly mention that starting on April 1st of this year, I'm going to be running a investing competition on my website, which is tickernomics.com. The prize for the winner is going to be a $100 Amazon gift card, and it's going to run for 6 months. All you have to do is enter a portfolio on my website, and instructions are included here. And I'm also going to put these instructions in the description of this video. So if you are interested in signing up for this, feel free to do so. Link will be in the description.